What happens if the stock brokerage you have your investments at fails? What happens if Interactive Brokers, Fidelity, Robinhood, any broker you have, what happens if they go bankrupt? Well, that's where the SIPC comes in. The SIPC stands for the Securities Investor Protection Corporation. Like the FDIC that I covered in my last video, the SIPC is a non-profit government-affiliated corporation. It was created under the Securities Investor Protection Act of 1970, which required most U.S. registered brokerages to sign up as members of the SIPC. So what does the SIPC do? It was created after the recession of 1969 to 1970 to cover customer financial assets in case their brokerage goes bankrupt. If your brokerage is SIPC insured, then up to $500,000 of assets are protected in case your brokerage goes under. The SIPC will work to get you that money back. There's no extra setup on your part, and you're automatically entitled to this insurance as long as your account is at an SIPC insured brokerage. Another aspect to keep in mind is that the $500,000 also includes up to $250,000 of coverage for cash that was in your account. So $500,000 in total, but up to $250,000 of that could cover any potential uninvested cash that you lost. If you're a non-resident in the US but your brokerage is an SIPC member, you're still eligible for the same protections. That goes for the FDIC as well. They'll still help you retrieve compensation. So which assets does the SIPC protect? Primarily anything considered a security that you purchased at an insured brokerage. This could be stocks, bonds, certificates of deposit, mutual funds, the list goes on. On the other hand, the SIPC does not protect anything banking related, like checking or savings accounts. Those are handled by the FDIC, which I covered in my last video. The SIPC also doesn't protect commodity or foreign currency futures contracts. As a beginner to investing, you won't really be buying those anyway, but those are contracts to buy or sell a commodity or foreign currency at a certain price. And there's no coverage for anything that is not considered a security. The last thing to mention here is that the SIPC is specifically designed for traditional assets and securities, and that means that crypto brokerages or exchanges are not covered by the SIPC. That's why people lost money at FTX. If you have your money on an exchange in crypto, you should consider other storage options to better protect your crypto in case those crypto exchanges fail, because the US government will not be helping you out if they do. Moving on, how do we check to see if the brokerage we're using is insured by the SIPC? You can either check and see if your brokerage has a disclaimer about it on their website, or you can look at the directory the SIPC provides on their own website. They have a list of all their members, and all you have to do is look up the name of your brokerage and see if it pops up there. The last thing to take note of is how we file a claim with the SIPC to get reimbursed if our brokerage does go under. First off, you should receive a claim form in the mail if you had an account at a brokerage that fails. You'll need to file that claim within the deadline set by the SIPC. The Bernie Madoff case, for example, went from December 2008 to July 2009 being the final deadline. So you don't want to put that off if that happens. The SIPC will review your claim, and they may ask you for more information. And after they make a decision on if you qualify for coverage or not, they'll send you a determination letter. If you qualified for coverage, which most people will, then you'll receive your initial delivery of securities or cash. And if you had over $500,000 in cash or securities in your brokerage at the time of failure, then you might receive additional payments later if the sale of brokerage assets is enough to get you your money back. It'll likely take months, if not longer, to see what assets you can get back, so unfortunately there could be a bit of a wait if you're involved in a process like this. And this is why we want to make sure we avoid being involved with any brokerage that could go bust if we can help it. Now my next video is going to go over what we want to look for when picking a stock brokerage to invest in. But for now, that's everything you need to know about the SIPC. If you'd like to learn more about investing basics, this video is a part of a larger playlist that goes over just that. If you're interested in learning more, that playlist will be linked in the video description and the YouTube cards. Thanks for watching.